it from there. So thank you very much, guys.
Okay. Thank you, Case. I'll go ahead and just jump in. So some of you guys are probably familiar with Agency Rocket. I know a handful of you guys already are using our system for the IUL sales system, where we are the whole point of that system is to replace an IUL with or replace a qualified plan with an IUL, and all the fun that goes there. And so you guys have been, some of you are customers there. This new system is really cool. We have a lot of people that are really, really excited about it. And it's really flying off the shelves, to be completely honest with you. And it's been very, very powerful, and we're very proud of it. We've got a lot of other things that we're building onto it that'll make it even better. But I'm glad you guys are here to spend some time with us. If you don't know the strategy of using a whole life policy to help someone eliminate their debt and then build their wealth, let me give you a 30-second primer on it. All right. You build a whole life policy. You have the client start paying minimum payments on all their debts. You want to try to identify as much money as you possibly can that they have. And usually the way you do that is if their minimum payment on a credit card is $200 and they're paying $300, well, there's $100. That extra payment is something you need to identify. And we put that towards premium in a whole life policy. We build up cash value in the policy. And as the cash value gets bigger, we take out policy loans to pay off the debts. That way the cash value keeps getting larger and larger and larger. Once we paid the Visa off, we take that $200 that we were paying towards the Visa and put it towards policy loans. So a lot of times we trade a 22% interest rate with like a 4 or 5% interest rate. We are gaining interest on our cash value the entire time. And so when you put all these strategies together, it really pays off the debt faster, and it creates a really awesome way for them to get a big nest egg. Okay. So that's the basic strategy. Let me show you our software, how this explains the strategy and how it all works. So here we go.
And if anyone has any questions or things along the way, feel free to use the chat feature, and we can kind of keep an eye on that, address questions at the end. We can look through that if you want to get a question out before you forget about it. I'll be around for the first part of this, and then I have to leave early. So I'll try to answer some of them live if you have some questions as we go. Otherwise, John will play question cleanup at the end.
Yep. Thanks, Sean. Yep. We'll do that. We'll do that. Okay. So when you purchase the debt action plan, it'll take you straight to this setup page. So you put your name in there and your company, all that kind of fun stuff. You can change the color of the background. I went ahead and put the Next Vision color scheme in the report, and I'll show you that in a minute. Then you'll list all your debt action plan scenarios here. So let me show you kind of how that works. I'll create a brand new scenario, and I'll just search for one of my existing cases. You guys that are familiar with our software, you understand that, I'll just pick one of these, it doesn't matter. You understand that our software has a prospecting component to it. It has a customer relationship management system or CRM system component to it. And it has these sales tools. So we try to keep everything nice and organized, but I'm just going to show you the sales tool right now, right? For the whole life debt action plan system. We'll talk about the other stuff another day. I don't want to bog you down with that. All right, so here we are. This is our first scenario. I'm going to give myself a little bit more room there. And what we're going to do, guys, is we're going to work our way across these tabs till the end, till we generate a report. And as we do so, the system's going to start identifying money that we can put into the policy. So we'll have monthly redirecting, which is going to be our monthly premium that we're going to redirect from paying off debts or insurances or whatever into the policy. And it might also identify some lump sum amounts right there. Okay. So let's go ahead and get started. I'll go in the mortgage tab first, and we'll add a mortgage. Now, just to let you know how the system works, you start putting in things here, and it just kind of saves in the background. You don't have to push any save buttons. Let's give this a $350,000 mortgage. Let's say the interest rate is 3%. It's going to tell me I need to have my payment at least $1,476. Now, what is that? That is let's go 77. That is the principal and interest only. Okay, that's not escrow or anything like that. So when you have your client statement, you need to find out what the P&I is only. Now on the next box, we're able to identify anything they're paying above and beyond the P&I. Again, not escrow, not insurance, but this is any principal payment that they're making above and beyond their minimums. Okay, so let's just say in this case, he's been paying $200 extra every month. Now, when I do that, you'll see a couple things happen. In the blue section at the bottom is where it identifies any overpayments. Okay, and you have the opportunity to monkey with that. If you want to just take half of it, part of it, whatever, you can do it right there. I'm going to go ahead and leave this $200. Actually, I won't. I'll go ahead and do $100 of it. For some reason, they only want $100 going towards the policy. So what happens? That $100 goes up here. And if you ever use something like TurboTax, for example, this is similar. You know, you go do your taxes, and then you have your federal and your state returns starting at the top, right? And they just keep accumulating. And it's kind of the same thing. So every time we go to different, and by the way, you can do as many mortgages as you want. I can have 50 mortgages, all right? We'll go to consumer debt now, and I'll add a new consumer debt. And let's just say we got a Visa. It's got a $20,000 principal on there. Pretty high rate, 22% rate. It's going to tell me my minimum needs to be at least 567. And now this is slightly different from the mortgages. Okay, the mortgage set, it just assume you're making your payment and whatever you put in here is any overage. This is asking for your actual payment. Okay, so if the minimum is 567, some people just round it up, right? So this is, let's just say the actual payment is 600, and it does the math, and if it identifies $33, all right, of overpayments on that one debt. Let me add another one. Let's say this is a Amex. Maybe there's $10,000 on that one. Interest rate of 24%. Now let's go less, 19%. $260, let's just say is the minimum. And he's rounding that one up as well, $300. And then he's got a, let's just say this is a high one. Let's just Chase account. He's got a good $15,000 on there. He's got a really high rate, like 29. Having to making his payments there. So his minimum is 512. Let's just say 515. And he really wants to pay that one off quickly. So let's say he's putting $800 towards that one every month. Okay. Let's add one more. So we have an auto loan. Let's call it 15,000. Maybe there's a rate of 7%, $240 roughly, and there's a little overpayment there too. Say $300. Okay, so this is a typical, maybe not so typical scenario. He's got about $60,000 of debt if you factor in his car note and everything, so it's a little high. But let me stop for a minute before I go any further and just think about this for a minute. I've got a client here that's got $60,000 of debt. He's got a house note of, what we say, $350,000. Okay, he's accumulating some debt. His income is probably a decent income, maybe 100 grand a year or a little more. And this guy is probably not a prime, and let's say he's 30 years old, probably not a prime candidate for life insurance because it looks like he's not really doing that great with his debts. He probably can't quite keep his head above water. Okay, so a normal insurance agent might maybe you can get him to buy some insurance or not, but he probably is not real interested at this point about retirement. He just wants to get his debt cleared up, and he's probably not interested about saving money, or certainly not putting money away into an insurance policy just in case he dies. Okay, that's just the harsh reality. But this is how we can help them. Okay, so let's go to investments. Investment can be a lot of things. It can be a savings account. That is not a qualified. Let's make it a savings. Let's say that there's $20,000 in that savings account. Okay, and he's putting, let's say $300 a month. I lied. I told you he wasn't saving any money. Well, he actually is. All right, saving a little bit. And then let's say he has a qualified account, a 401k. And he's got a pretty decent amount in there. He's been putting it in there for his employer has for quite a while, and he's putting, I don't know, $300 a month. Okay. Now we have the opportunity to take some monthly amounts and some lump sum amounts. Now it totals up any values here in our lump sum. Now I don't want to take all $170,000. I mean, it'd be great to, But I really don't want to do anything with that because I don't want to incur any taxes or penalties. I really just don't want to deal with that right now. So, the client said he doesn't want to give me all of his savings. So let's just say he wants to give me, I don't know, $5,000 of the savings. Okay. And he's okay with giving me $500 of what he's contributing. I don't know why. That's what he determined. Okay. So you'll see my amounts keep changing up here. We've got $1,000 roughly so far and 5,000 of lump sum. And all we've done is just gone over what he's spending. We haven't really talked a lot about the strategy. Let's add an income source. Let's just say this is me. So let's just say John's paycheck. Okay. And John makes, let's say, $12,000 a month. Okay. If you wanted to put more money into the policy and you didn't want to attach it to a debt or anything, or maybe the client doesn't even have any debt, then just put it here. Just put $200, $300. I don't know. I'll put $50, whatever. Now I'll go to, and by the way, you can put as many income sources as you want. Rental income, list it all right here. It's great to have all that data. And I'll go to insurance policies. So let's say we have a term policy and they're putting, let's say, $200 a month into, there's a $200,000 death benefit and there's no cash value in that term policy. All right. So down here, again, it will identify any money that we can use towards the policy. No cash value, so there's nothing here on the lump sum, but we do have an opportunity to take that $200 and redirect it into a whole life policy. And we're going to go ahead and do that. So we'll go ahead and stop this policy here and start redirecting that $200 towards their debt elimination. All right, now I'm done. So I have $1,200 and roughly $68 of premium per month going into this policy and a $5,000 lump sum coming from their savings. And usually what you would do right now is you've gotten all the information from your client. You'll schedule another appointment. You'll take this information and go create a whole life policy with that much in premium and that much in lump sum. And you'll come back and have a second appointment. Now on the second appointment, we'll go to the report page. Let me show you how this works. First off, we have a few settings here, which we'll talk about in a minute. I have the ability to upload my MTL illustration. I'll go ahead and start my illustration uploading right now while I talk to you, okay? See if I can find one. You probably can't see this on your screen, but I'm just searching through my computer to find a illustration. And by the way, this is the PDF file that you go in your carrier's back office, you download it to your computer, and now you're uploading it to our system. The raw PDF file, no CSVs, no copy pasting, nothing like that. Send the whole PDF up there to us. And our system will then parse through every page, analyze it, grab all the data, and get everything ready for you. So you just sit back. It takes about 30 seconds. Okay, done. And now what happens now is we have this illustration section where I can delete it. So you can start over if you'd like. I can download it and look at it. I can generate a report now. And it also gives me some rough numbers right now. Okay, so first of all, it's telling me that my current path I'm on, I'll have everything paid off in 24 years and 8 months. That's if you take all those payments that we said that we're making and just project the math out 24 years. Our plan is going to have it paid off in 10 years and 8 months. Let me just check real quick and see if that's the best strategy. Right now, it listed them in the order that I entered them in. But I have some options at the top where I can select Snowball. Snowball, if you're familiar with that, it starts with the lowest principal first so that you can get some momentum. Pay the first one off and get to the next one, right? And Snowball looks like it's going to save us $52,008 of interest. If I select Avalanche, which is the highest interest rate first, and it goes down, looks like we're going to save $53,828 in interest. I can't remember. I think that's a little bit better. So, and the time went to 10 years and 5 months. Okay, so it looks like that's the way we want to go. I can generate a report right now, and I'll show you that in a minute, but I'm not going to show you that right now. Okay, the report is a really pretty 10-page PDF, beautiful graphs all over it. It's really nice. But I'm going to show you this tab here that we created. It's called the comparison tab. And this was put together so that you could help explain what the heck is going on with this policy. Okay, So the first thing I want you to see is that we have all the debts listed here. And we have the blue section, which is the current plan, and the debt action plan is in green. And we're just going to compare how these debts pay off. On the first month, there's not a whole lot to compare. They're both at 0%. We got a little bit of action, but I can drag my month slider and you can see things start to happen. Okay. And as we just make all the payments we said that we would make, at the end of 1 year, it looks like the blue, the current plan, is 5% finished, and we're only 3% finished. And that kind of doesn't look that great, but it does make sense because we've told them on our plan, we're going to make minimum payments towards your debt while we build up cash value. And on this plan, they're actually making some overpayments. So in the very beginning, it will be a little bit slower. But let me show you what's happening. Let me open up the Your Bank part. We have 12,741 of cash value already. So that's part of the equation here. Let me go ahead and go into year one and see the slider zips back there. And let's find when our first, oh, there it is. Okay, our first loan happens in year 1, month 2. So let me show you something, Mr. Client. So you'd have this conversation. In year 1, month 1, I have a balance of 12,000 and change, 12,7 and change on the debt action plan, on this Visa, or excuse me, on the Chase. And we have $13,800 of cash value in my policy. So the system triggers a policy loan. And look what just happened in month 2. So that thing was completely paid off. And we took the money from that. We took out a loan in our policy of $12,494 and paid off the Chase. So now we're 7% done. And this one's 6. So we just passed the current plan. Okay. Now, sometimes a client will see this and go, wait a minute. You didn't really pay anything off. You just transferred the debt from that card to the debt on this policy. And that's somewhat correct, but that's not the whole story. If I called up the insurance company today and said, I want to liquidate this policy, I'm done with it. They'll take my cash value, which is cash, liquid cash. They'll subtract any loans I have against it, which is there, and they would give me the leftover. And we would still have our Chase paid off, and we'd have a check for $2,400 in our hand, and everybody would be happy. So yes, that debt is actually paid off, even though you see a cash or a policy loan against that cash value. Does that make sense? So don't get hung up by this red number here of a policy loan. When you factor in the cash value, we're actually ahead of the game. All right, makes sense. So let's go ahead and go to the next debt just to show it to you. When does it happen? Let's see. Oh, didn't happen the first year. Let's go to year number 2. Oh no, it happened. Okay, it happened the last month of year number 1. All right, hold on. Let's back up here. Oh, the first month of year number 1. Excuse me. Okay. What am I doing wrong? Oh, year number 2. Last month of year number 2. Is that what I'm saying? All right, I'm doing this wrong. Sorry, guys. Last month of year number 1. First month of year number 2. Okay. That's why it's messed up, because if I were to show you the month before it, it's the last month of year number 1 and the first month of year number 2. It's just the debt gets paid off in December. So it just kind of messes up here. All right. So anyway, but you can see that we took a second policy loan to pay off the Visa. And that balance went up to $21,000, but we still have $6,000 of leftover. So again, if we called up the insurance company, liquidated it, we'd have a check for $63.21 sent to us and 2 credit cards paid off. Okay. Now I'm not going to show you every debt, but let me just go ahead and drag this. See, there's a 10 right there, and there's a 24 right there, right? The green and the blue. I'll drag it to the green 10. When I do that with my year slider, all of a sudden the month badge shows up. So I'll drag my month slider to month number 5. And that's the time when my debt action plan is fully paid off. Year 10, month 5.
I don't know.
Okay?
I don't know nothing.
So,
I don't know that either.
let me see if I can.
I just need to know. You're telling me to look back at the thing, like I'm supposed to know who I'm looking for, who started the hire here, who did. I don't know that.
Let's do that. There we go. Sorry, whoever I muted, but I couldn't hear. All right, so year 10, month 5, debt action plan was fully paid off. Okay. And we do have a policy loan that helped pay off that house note, right? Let's go back 1 month and you'll see it. we've got $262,000 of debt left on that house, but we have a savings account balance of 120 grand and a cash value balance of 169. We put them both together. We have 289 left. The system triggers a policy loan. Bang, house is paid off. Now, again, same principle here. If we called the insurance company up and liquidated this, they would send us a check for 31 grand and we're done. House is paid off, everything's paid off, 31 grand's in our pocket, we're happy. But we don't want to do that because there's a lot more awesome things that this policy can do for us besides just get us out of debt, which it did in a very awesome way, 10 years, 5 months, right? Let me show you what it can do for us. I'm going to drag my slider to the blue 24, which is when the current plan runs out or current plan is paid off. Bang. So in the year 24, 8 months. In your current plan, this is when you'll be paid off. Okay. So now we're even, right? No, not really. The debt action plan has almost $1 million of liquid cash sitting right there waiting on you. And that is the most powerful part of the presentation is that I'm not asking for any more money from you, Mr. Client. All I'm doing is tweaking your strategy slightly. Instead of making extra payments towards your debts, I'm going to ask you to put payments into this policy to build up your cash value. The cash value earns interest, so we want that thing to be really, really high. And we're going to take out loans. Oh, I might playing some music here. Let's see if we can mute that one. There we go. All right. Where was I? Let's see here. Okay. I can't remember where I was. All right. So in the same time that the current plan paid off your debts, we got you $1 million. Most powerful part of the presentation. Okay. But what if in year, I don't know, year 13, okay, we wanted to buy an RV? Well, instead of going to the bank and asking for a loan and having them do a credit check and whatnot, we have $175,000 of assets through our policy. We could take out a policy loan and buy that RV tomorrow. No questions asked. And pay back a very low interest rate, keep that same money we've been putting to all these debts and keep paying off the policy loans and building up that savings balance and cash value. So maybe that would pay off in a couple of months. And then maybe in year 20, we want to do well, gosh, there's a lot of money there. Let's go a little further backwards. Maybe in year 16, we want to do a renovation to our home. We have $350,000 of assets in our bank that we can borrow from and get our home redone. Again, it paid off quickly, very, very low interest rate. Off we go. Maybe there's some college funding we need to do for our children, right? This policy can be used to transform your client's life financially. Again, all without spending any extra money. We're not asking these folks to alter their lifestyle at all. We're not putting them on a cash envelope budget. We're not having them eat rice and beans and cut back on every little thing on their lifestyle to try to find a little bit of money to pay extra towards the debt, right? We're not doing that. That is not the best strategy, even though some folks on the radio say that it is. This strategy doesn't touch their lifestyle. If they want to cut their lifestyle and make it go faster, that's great, but they don't have to. By putting it through the cash value, putting it through the policy, letting the cash value grow and grow in interest and get larger and larger and larger and taking loans against it, it's a much better financial situation. And with this situation here, with this comparison tool, you can prove it to them. Okay. Now let's go back to the report tab. Remember I showed you we had a report here that I'm going to generate. So let me generate this report, and this will kind of explain the strategy. Of course, real quick. Okay. Click generate. And it's generating. And let's click download. Oh gosh, give me a minute here, guys. It's going to load up in the browser. Here we go. Okay, so I've got my logo there, my colors. By the way, I can change the colors and logo on this report. Here's Tiffany Test, I guess, and here's everything. All right, so there's our cover page. Here's a disclaimer. And then guys, we get right to the meat of it. We say we're going to save you 53 grand and pay your debt off in 10 years, 5 months. Okay. Your current plan is going to pay off in 24 years, 8 months. We're going to pay off 10 years, 5. That's awesome. But that's not the end of the story. Right? We know that we're going to also build a whole lot of wealth for them at the same time. Let's go to the next page. Here is the strategy description. 4 steps. 1, we're going to identify the inefficient payments, which we already did with our software. We're going to start making minimum payments to all your debts while we build up cash value in our insurance component right there. Then we're going to take policy loans to pay off the debts. We're not going to take money straight off the cash value. We're going to let that grow. We're going to take policy loans out. Okay, those are your 4 steps to the strategy. We're going to take that inefficient dollars and redirect them. And this is where it all came from. $200 for their insurance that we stopped, overpayments to debt, overpayments to mortgages, a little bit of investments. I think we had a 401k that we were stopping and all that kind of fun stuff. It all added up to $1,268 here and $5,000 of lump sum. Okay. As I scroll down, it'll show your current plan. This is where you are. This is how long it'll take every debt to get paid off. Okay. Every debt here, the balance, all that kind of fun stuff. All the red is all the interest we're paying on both of these. Okay. Keep scrolling down. Here's the debt action plan. Now here's the old date, the current plan's payoff date, 10/10/23. This is 10/10/22. 1 year off, 1 year quicker. Old date, new date, old date, new date. Once you've paid off the chase, you're going to take that payment to redirect at 515 and put it towards the policy loan. On the chase, we've saved $500. On this one, we save 3,200, excuse me, $600, $400, and then $49,000 on the home. And just all the math's right there for you. We'll scroll down. That's not the whole story, right? Yes, we're getting you out of debt early. Yes, we're saving you a bunch of interest, but we're also building up some fun assets. In 20 years, you have $619,000. In 30 years, you have 1.4 million. In 40 years, you have 2.5 million. That is liquid assets. That is savings account balance plus cash value in your policy. We're not talking about death benefit or anything like that yet. Those are additional benefits. We're just talking about liquid cash that we're building for these guys. Okay, so we're building wealth. Of course, we are having all this. We have a death benefit, terminal illness, et cetera. You guys know that part of the equation. You can explain that to your client of all these bonus things that you get above and beyond the debt pay down. And this is the important dates of the policy or the plan, excuse me. We're going to pay the Visa or this chase off on 10/10/22. It's going to be the amount of $12,494.95. And we're going to take the 515 that we're paying towards that chase, and we're going to put that 515 now towards the policy loan because the chase is gone. So the payment is gone too. So take that extra payment there, put it towards the policy loan, and start paying that down. And then on 9/12/23, we're going to pay off the Visa with that amount. And we're going to take the 567 of minimum payment we're making towards the Visa, add that to the 515, and put both of those amounts towards the policy loan. See how it kind of gains momentum as these things get paid off. 10/23, 5/10/24, and then at this moment, January 10th of 26, we have to open up a savings account. Now, why are we doing that? Well, that's because all of our policy loans are paid down. So we put all this extra money. If you add all these up, whatever that amount is $1,500 roughly. The $1,500 that was going to all these debts, and then we redirected to pay off the policy loans. Now the policy loans are paid down. They're gone. So where does the $1,500 go? We can't put any more in the policy or it will become a modified endowment contract, a MEC. We don't want to do that. I'll add some tax liability to it. So we take the $1,500 and put it into an outside savings vehicle. That makes sense. And so the savings vehicle starts gaining and the account gets higher and higher and higher while our cash flow or cash value gets higher and higher and higher. Okay. So this is a time here that we need to open up a savings account. And of course, this is when we pay off the house note. Now, let me stop for a minute. We have 1, 2, 3, 4, 5, 6 opportunities to talk to our client. So a good agent would jot down these dates, pop them into a calendar or a reminder program with your phone, and you want to call your client up and says, hey, it's 10/10/22. How's that chase looking? We ready to go ahead and make that Policy loan? Yeah, let's do it. And you want to hold their hand through that process. It's an opportunity to touch these clients each one of these times. Now, that's what a really good agent would do. What a really, really good agent would do is on this date, we might want to put them into something a little better than a savings account, okay, that draws 2% interest. We might want to put them into an IUL or some other product, right? And so we'll get their retirement even more turbocharged at that time. Okay, let me scroll down here. Here's our next step. Let's start making minimum payments. Let's apply for the insurance. Let's schedule our first loan payoff. Let's redirect our inefficient dollars to the new plan and start making your money work more efficiently. Okay, great. And there's a happy family there. And that's it. That's the whole report, guys. Now, listen, these people that are in debt, like I said before, they're not really the typical client you'll have, but there's a lot of them. And when you show them the software, show them the savings, show them the strategy, show them that they're not paying any money for software. They're not buying some kind of software package. They're not sending you any money at all. It doesn't cost them anything. They're just redirecting money that they're paying off their debt very inefficiently. That's all you're telling these folks to do. And my goodness, a policy with that much monthly premium, that little bit of lump sum, that's not a bad policy. That's not a bad policy. Do you think you can do this all day long? We have people that are doing this all day long. We have a lot of folks that are using our system and they are just, they're doing really good. I'll just leave it at that. They're doing very well. And this is these clients that you're getting in front of, you're their hero. They are paying off their debt fast and they're excited, and you made a wonderful high commission and everyone's happy. And that's really it, guys. That's it. Let me show you what this thing costs. Okay. Go to agencyrocket.com. The debt action plan is $149.95 per month. Or you can pay it annually and save 10%. And a lot of you guys are using our My New Retirement System. That one's $60 a month, roughly. If you wanted to bundle them, there's some savings and things, right? So if you bought this guy and you added that guy to it, it only would cost you $39.95 to add that to it. So there's just some savings here. But that's the monthly cost. It's month to month. You can cancel at any time. We don't ever lock anybody into anything. And to get started, there's an address right there. So we just set up a team page basically with NextVision. So if you type in that address, you'll get a small savings on your first month. And you also get that branding, the team branding for NextVision already installed on your system. Select Debt Action Plan as your base system. Let me see if can I copy that? I guess not. Let me see if I can go in there. NextVision, there it is. Okay, so I'd go there and I'd create a brand new account. And I can check the debt action plan or the My New Retirement as my base, right? See that? So I'm going to leave it as debt action plan and just sign right up. And then you'll go into the system and it'll ask you to put a credit card down and pay for the system, and then it'll take you right to the setup page and you'll be ready to go. And that's how it works. Is there any questions? Sean, are you still on? Or is anybody else still on watching the questions? Because I'm not. Let's see. Oh, goodness, there are a lot of questions. Let's see. Can we use multiple insurance companies? Yeah, there's a handful of insurance companies. I think, I'm not sure, Case, maybe that's a question for you to ask, but I think MTL is your preferred carrier, if I'm not mistaken.
Yes, we're using MTO for this, but if you don't have a contract with MTO and you'd like to check out other carrier, do let me know too, but MTO is our preferred carrier for the software.
Okay, very, very good. How do they access the cash? So, Case, you want to answer some of these, Case, or would you like me to?
I think let me see. I think
how do they access the cash value?
I invited Kip Walker from MTO here, just in case we have any other questions.
Oh, sure, yeah,
great.
Great.
The policy for him. So let me check to see if Kip is here. Kip, are you still here? maybe you can help us answer some of these questions.
Did he make it on?
Okay.
If not, I can answer it. I just wanted to.
Yeah, go ahead, and then I'll have Kip jump in when he gets a chance here.
Yeah, so honestly, the client can just call up the insurance company and say, I want to take out a policy loan against my cash value. And it's a pretty easy process, and then they'll deposit it right into your account. It's really that easy. Then you'll have access to that cash, and the policy loan will start. And remember, once you pay off your debt, you start putting money towards that policy loan. So you'll make a payment to the insurance company to go towards the policy loan. Okay. I think the next question looked like there was, what's the interest assumed on the whole life policy here? I'm not sure. From the illustration that was put together, that's how they credit the cash value. I think that one might have been 7.5% or 8%. I'm not 100% sure what the guaranteed interest is on that one. So that'd be something that your MTL rep will tell you, but we didn't have to plug in any kind of interest rate there. It's actually off the data that we pulled from the illustration. Okay, and it's not even a number. We just the cash value, how it accumulates. They've already done all the math there for us. Okay, let me just scroll down here. Cover student loan debt also. Yeah, so that is a addition that we are finishing up. I was hoping to have it ready before this presentation, but we have a handful of new features coming out in the system. One of them is student loan debt, meaning you can defer that payment off a few years in the future. Okay, so that is coming any second now. Right now, you could just go ahead and put it in as a normal debt, and our system would pay it off, and it would look great. Just the current plan paying it off would just pay it off a little quicker than it probably should. Not the end of the world, but we do want to get that thing fixed up for you. Another couple of things that we're adding, guys, is a whole lot more settings. You can determine the cash value percentage that's available. Right now, it only lets you borrow 85% of the cash value, but we'll let you slide a slider and let it borrow more or less, just to make it a little bit more conservative or not. We also are going to let you upload multiple illustrations, and it adds the cash value together to do the comparison, which is kind of fun. Instead of opening a savings account, wouldn't you better get a new policy? You're exactly right. You're exactly right. It would be better to do a new policy and set that up for them, because it would gain a lot more than the 2 or 3% of their savings account. And yes, you would make a hefty commission on that one, because what you're doing there is you're taking all that roll-up money, which might at that point be $2,000 or $3,000 a month in debt that you've already paid off, and you're creating probably an IUL out of that with that very high monthly premium, right? So that's a very hefty, nice commissionable product there, and it's wonderful for your client. I'm not saying that because you want to make money. It's a fantastic option for your client. Mutual trust, I said it. I think the interest rate very depends on, yeah. So here's some people trying to answer. Yeah, exactly. Where'd you put in the parameters of the insurance company? Okay, dividends. So I'm not going to get too far into case design. I'll save that for your MTL rep or other folks that want to go more into that. But there's some nuances to putting this thing together to get the maximum value out of it. And so I would definitely recommend maybe a training on how to get that together. But our software just takes the illustration once you've done with it and displays it for the customer and makes it nice and pretty. So I'm not really going to go into that if you guys don't mind. I hope you don't think I'm not dodging that one. I just don't. That's just not the scope of this meeting. I think that's all the questions that I'm reading. And if I missed any, let me know, Case. Or if there's any other questions, let me know, guys. I'd be more than happy to answer them if I can.
We do have a couple of videos that show you how to design an IBC case or a debt elimination illustrations with MTL. So let me know. I can email that to you guys, or check out our YouTube channel. There should be some videos there. Otherwise, give MTL a call and they'll be glad to run some illustrations for you.
Very good. I'll give you. I'll say a few more things, and then then I'll be gone. Okay, I'll be quiet. But we do have a few more things that we're adding to our system. So I think you got a lot of you guys that use our system know that we have a prospecting component. So what the way that works is we'll have a website that every subscriber gets a landing page on that website. We'll have some introductory videos and some webinars that your clients can register for. Once they register for these different webinars, they flow into something like this. They flow into our pipeline, where you can move these people around like that and drag and drop cases back and forth and keep track of your business. And we have some training on how our CRM works in other places, and that can just kind of keep up with everything. It's once you know how this thing works and what these colors are, you want to turn every case green. And so you can, as you can tell, I'm doing terrible. I've got red and yellow cases, but that's another aspect of our software. We have the prospecting tool, we have the business management tool, and then we have the closing tools, where you can go in and use our debt action plan analyzer or debt action plan scenario builder. Let me also just give you a little preview of what's coming. So on the comparison tab, one of the things that we're adding, if you noticed, I was kind of doing it. This is a different scenario, but remember when I said, hey, in year 15 or whatever, we're going to get an RV? Well, we got another section down here that's going to be available. We'll just kind of minimize that one. The other section will be here, and it'll be future expenses. And you can put some scenarios together. Let's say in year 17, month 1 or whatever, you want to buy an RV and it's 100 grand. Well, it would show you how that would actually affect the cash value. It would add the loan to the policy and show you how fast that pays off compared to traditional banking. Maybe you could throw a 7% interest rate or whatever you think you get on that RV or whatever it was. And it would just show the difference, how you would save money on these future debts. And so you could just stack them up, an RV here, college for your kids or whatnot. And you could actually use this system to not just deal with debt. We could not even put any debt in. We could just go here to the future expenses and put in college. So let's say in 6 years, you need 120 grand for college. Well, we'll show you exactly how that would work using a whole life policy and how it would be paid with a cash value policy loan, and how quickly it would pay off and how much money you'd still have in there as cash value. So you can start using this system once that's finished as a little bit more of a college planning piece. You can show a lot more fun things on the personal banking kind of scenario instead of the debt elimination scenario, right? We also are going to have more settings on our report. I think I told you before that we're going to let you slide the cash value percentage slider. Right now it's hard coded at 85%, but you can make it go from 80 to 100 or whatever. So if you do that at 100, we also have another slider that is a emergency fund. And that's not a percentage, that's a hard number. So let's say you set an emergency fund of $5,000. Well, that tells the system that when we take out policy loans, we're never going to max it out. We're going to always leave you a $5,000 cushion there, just in case you have an emergency and your car breaks down or you need a new engine or whatever. You have $5,000 of cash value at any given moment that you can call tomorrow and get it and fix your car. So that's another cool setting. There's a handful of others. We don't need to go into them. There's about 6 or 7 more settings right here that you can do for your report to personalize it even more and do what's best for the client. And that's pretty much it, guys. Those features should be done by next week. We're previewing them right now. Our development team is finished with them. We're just kind of making sure everything's working correctly like we like. And probably next week we'll go ahead and launch that and release those new settings. But that's it. Case, got anything else you'd like for me to show, or would you like to?
Right, John. Yes. When is that prospecting the reach feature becoming available?
I knew you'd ask me that, Case. It is. Oops. It is. Oh, I'm gonna have to give you an educated guess. I'm going to say about 3 weeks out.
Okay.
A lot of the components are ready. The website's being put together. One of the videos is finished. Another video is almost finished. A lot of the messaging for the website's there. The code to make the website work with our system is already in place. So a lot of it's there. I would give it about 3 more weeks though, just to be safe, just because I want it to be done, all the bugs worked out, and it work.
Okay. I think that would be wonderful, because prospecting is a key to success in this business. So that would really help, the agents to prospect and reach out to new clients for the potential sales. So I think that would be wonderful. One of the questions asked to see if there will be additional fees when you
No,
incorporate.
no. So all those things that I was telling you, we're going to add the reach platform. We're going to add all this other stuff. That's all going to come with the base price. We factored that into the price already, even though some of those things weren't there. So we're not going to up that price at all. So everything's going to be included.
Okay, wonderful, wonderful. Well, guys, when you register for this system through our link, you'll get a small discount there. But if you're very serious about making a lot more money with this program, with the system, talk to me. I do have an additional, reimbursement program from Next Vision Financial Group here to help our agents to grow and use the system and make more money. So depending on what your plans are, how much productions you can, do and things like that, we can even give you a 50% reimbursement or 100% reimbursement. Basically, you can get the software for free too, but you got to talk to me about that and we'll design a plan for you. Okay. So we're very serious about, having you learn this program, the system, use it to make a lot more money here. So talk with me. I'll put a plan together with you and I'll help you and we'll grow this thing together.
Okay, you guys are in the right company because what Case just said is fantastic, right? That is such a next level support. So you guys are in the right place at the right time. Great job, Case. I really appreciate that.
Thank you. And I really like the software. I believe the software can really help all of us to make more money, to write more premiums and a lot bigger premiums and have a really higher closing ratios for all of us. So take advantage of this system, guys. Subscribe and let's talk and put a plan together and we'll have a successful year. Okay.
Sounds great.
Great.
Thank you, guys. Thanks for just sticking around for a little while.
All right. Thank you very much, guys. Thanks for your time. Okay. Let's talk soon. Thank you.
All right. Sounds good. We'll see you guys. Thank you.
Thanks. Bye-bye.